Welcome to the CDBG RLF ED Compliance Report webinar. I am Deb Whitener and will be hosting the webinar. You can type in any questions you may have in the chat box. Today we will be discussing the new changes to the compliance report, which will include follow-up on defaulted bankruptcy loans, HUD Integrated Data Information System or IDIS, and job performance reporting. Besides the compliance report changes, we will also discuss what needs to be in agreements or contracts, Section 3 reports, and RLF ED monitoring. Just a reminder that UGLUG means Unit of General Local Government, which are counties, cities, villages, towns, regional, and 105A15 entities. Reports and supporting documents must be submitted by Monday, May 16, 2016 to the DOA DEHCRC Community Development at Wisconsin.gov website or email. Please make sure when you submit a document to DECR, whether it's this report or any others, that the UGLA's name is in the subject line of the email and on the attachment. This year, two problems occurred. When the single audit documents were received, the email box was subject single audit. It took me a few days to realize when I moved the files, I was overwriting other single audit files. Also, when I was trying to find an email with a compliance report attached, the UGLUG's name wasn't in the subject line, and the two contacts that were on prior reports did not send in the current report. So I couldn't find the compliance report when I searched the email. So it's just easier if you always remember to put the UGLUG's name in the title box. These are the required documents you need to submit by May 16th. Your Excel copy of the compliance report, the 3/31/16 bank statement, general ledger, balance sheet, documentation of the administrative expenses, employee self-certification form, and an inactive loan summary. The inactive loan summary is a new document, and we'll be talking about that a little bit later. Remember, when we say the 331 balance sheet or general ledger, this must have, whatever document you send in, that must have the outstanding balance of each loan indicated. Okay, here comes the usual warning. Don't delete rows, columns, and RLF performance worksheets. Deleting it will result in formulas being corrupted or eliminated. Rows, columns, and worksheets can be hidden, but do not delete. If you delete, it causes problems. Just don't delete. Okay. You can continue on with your PowerPoint, and I am going to the Excel worksheet. There are no changes on this first tab, the General Information tab. However, a lot of the reports are still missing the DUNS number, and a lot of reports are still missing the contact information for the DECR website. If you do not have that information in, please ensure that you include the information when you submit this report. The next tab is the ED tab. You will notice on your ED tab, if you have any ED loans, that the IDIS number in column D is filled in now. However, there is one loan that doesn't have an IDIS number, and but otherwise all of them are filled in. You will need to include the IDIS number on the Funds Remit to State tab and on the remittance form. We'll go over an example of this in a few minutes.
We're having some audio issues. Can you ask the participants if they can be on?
Okay, I just got told we have some audio issues. Can you hear?
If you can't hear, send a question.
Well, telling them if they can't hear doesn't help. Why don't you put it in the chat mode? So if you can hear, just send a little chat saying, yes, I can hear. I'm getting nothing.
Yeah, okay, I think everybody's, we can proceed. There was one question about self-cert, but we can get when you're ready.
Self-certification forms? Mm-hmm. Yeah, we'll touch self-certification forms in a little bit. Okay, we're going to go to the RLF sheet. The RLF sheet, the IDIS numbers have not been added because they have not been added into IDIS by me. As soon as they are added into IDIS, you will now have an IDIS number. Until it is added, please use the 0002 number. There are two columns that have been added to the RLF sheet. You may or may not be able to see them. They're column Q and R. They are supposed to be hidden. I'm only telling you about this in case they become unhidden or I did not hide them. These columns automatically populate from the RLF performance sheets and are only used by me. So that's why they're hidden and why you really don't need to worry about them at all. And now mine are hidden. I just wanted to let you know. Nothing has changed with the closed loan tab. The funds remit to the state tab has changed. If you look at this tab, you will now see that it has an IDIS number, an individual amount, a total deposit, and the reason for the return funds being over the cap. Now we're going to go through an exercise, and your three slides here should help you. Oh, I need to go back to the RLF file. I'm sorry, I got ahead of myself. There's a new procedure here. If you have a loan that hasn't been repaid in the last 6 months and should have been, and it's bankrupt, or it's defaulted, or it's delinquent, you need to send in a special separate Excel worksheet or Microsoft Word document that explains why. And in here you need to indicate the name of the loan, why it's in the reason why it hasn't been repaid. So it's defaulted, bankruptcy. The follow-up that was done, such as collection activities, you sent certified letters, you filed legal papers and bankruptcy procedures, you enforced the contract requirements concerning guarantees and collateral, you turned it over to a collection agency or the Department of Justice. And then you also need to indicate the steps that will be taken in the future. The reason that this needs to be done is we have so many old loans from 2004, 2002, some even from the 1900s that are still on the books, and there's been no effort, well, I shouldn't say no effort, there's been no collection on it or partial collection on it. if all collection efforts have been taken, and please realize you don't have to wait till the end of the loan to start collection efforts. You can write off your uncollectible loan. When a loan is written off, it should go to the board that approves the RLF ED funds. So if it's your common council, it goes back to the common council. If it's a ED Group Economic Development Corporation like we have up in Ashland, it would go back to your Economic Development Corporation. The board should be given the background of the loan, including the amount of the loan, the outstanding amount not paid back, the length of time delinquent, and the procedures that was followed up to collect the loan. The minutes of this meeting, along with the collection documentation, should be maintained in your loan file. This will be one area that will be monitored. By the way, all collection efforts must include certified letters and filing claims against the collateral and guarantees before it can be written off. Any questions?
So there was a question about DUNS number.
We'll catch that at the end.
Okay. No new questions right now.
No new questions about this document that needs to be sent in. Okay. Okay, now we're going to go to the funds remit to the state tab. Remember, only include the reimbursements that were sent to the lockbox for the current time period. Enter the IDIS number in the IDIS column, and you'll be obtaining the IDIS number from the remittance slip, and you enter the amount of each payment, each loan payment in the individual amount, and in the total deposit amount would be the grand total. Now, the next 3 PowerPoint slides is your example. So one of the sheets is your ED sheet. So ABC loan has an IDIS number of 165. And it had paid back $9,500. Now with this agreement that we have with ABC Loan for this example, 50% can be retained by the UGLUG and 50% must be sent back to the state. So for ABC Loan on 121, the 165 IDIS number tells me it's ABC Loan, and it was $9,500, I think, and $4,750 was what was deposited. The second SAM, the IDIS number is $1,573, and the principal paid is $7,500, and that means the funds remit to the state is $3,750. And the $1,573 is there. And then the last loan we had was XYZ. And the IDIS number is 7514. And they paid back $15,000, and that means $7,500 goes back to the state. And that's what's deposited there, and the IDIS number is 7514. Your total deposit is $1,600. Now, when you go to the remittance form, the 3 loans are written on this remittance form by IDIS number, the contract number, because these were ED contracts, the business name, the amount that was paid back, and the amount that was remitted to give us $16,000. And that will agree to the funds remit to the state, and that is 1/2 of the $32,000 that's on the ED funds. That's how these three are tied together. So you get your original IDIS number from the ED sheet to fill out the remittance slip. And the remittance slip would be the thing that you would help fill in your funds remit to the state. And the reason why we added the 2 columns, individual amount and total amount, is because of the IDIS number. We need them to be listed individually. Now, I also gave 2 other examples. The first one, they paid back $30,150 because they were over the cap. And so the IDIS number is 2 and $30,150, and the total deposit is $30,150 over the cap. And the next one is just an example of ED all by itself. Okay. That should take you through all the examples of the IDIS number.
So we have a couple questions.
Okay, Ben, what's the questions?
Susan Henry asked, what does K reference in the column?
The question is, what is K? If you go back to your RLF and you work down the sheet and you see K is bankrupt. It's on the bottom of the sheet. Remember your key for the purpose of the loan is first, and then for the status of the loan is second. So K is bankrupt.
Jesse Bartman asked a question about this does not pertain to EDRL loans, correct? Doesn't say what this is.
Jesse, I'm presuming you mean this is filling in the indication of bankruptcy to tell us why it went bankrupt or you don't have any payments. And I would say yes, it should also include the ED loans to tell us why they're not getting paid back. So both for telling us why they're not getting paid back would be both for the ED and the RLF ED loans. And if, Jesse, I interpreted your question wrong because we're not sure what this meant, let us know.
He says he means the repayment to the state.
The repayment to the state, yes. It's the RLF ED is the one repaid to the state. If you have an ED out for the state, from the state, that the village, the town, the city, $300,000 as a grant, and they could loan that out to a borrower, and that money would then come back into the UGLUG, and depending on what the agreement was, the UGLUG may or may not be able to retain all or a portion of that funds, and that flows into your RLF ED revolving fund loan.
So Sherry has a question. She says, how do we know that the percentage of the loans that get repaid to the state and what's retained?
Sherry wants to know about the ED loans, what's the percentage and what's retained. I will be honest with you, when we accepted these loans back, or when we received these loans back from WEDAC, we don't have a very good idea of what should be paid back and what shouldn't be paid back. But in the next 6 months, that is my second obligation or my second responsibility to find out. That was decided about a month ago. So right now, we're basing it off what the UGLUGs are submitting to us on paying back. And these are only the ED loans. The RLF ED loans, you retain that fund. These are only the ED loans we're talking about.
And then one other question from Dan. Does the DOA agree that if the loan committee has agreed with the business to change the loan terms, thus avoiding the default situation. So I think he's asking if agrees if.
I think I'm just going to answer it this way, and I think it will be up to you guys. An ED loan, you have to go through DOA to get changed, the contract. An RLF ED loan, that the contract is from you to the borrower and the state's not involved in it, and you need to change the loans to avoid defaulting, that is up to you, and it's according to your RLF manual, and it's according to your board, your committee. The one thing you can't change is the job performance or the job creation. But if you have to change the term of your loan to 2% versus 4% to take it from 12 months to 36 months, that is up to you as the entity with approval from your board.
Sherry has one follow-up question about repayment. She says, so we have an RLF and we have been submitting funds to the state, so has this been incorrect? They're saying ED loans need to be repaid to the state.
Who's Sherry? What city?
Sherry Siebert.
Yeah, I'm not sure where you're from, Sherry. I can't remember. We can talk one-on-one on that, on Sherry. Give me a call and we'll talk one-on-one on that, because I would have to investigate. Okay.
And that's it.
That's it. Okay, and we understand about the IDIS loan numbers. Okay, we're on to the administrative expense. This hasn't really changed, this tab, except if you had carryover, because it's the second 6 months of the year. That carryover from the first 6 months came into here and was written in. If you didn't spend it all, it's a positive. If you overspent your allowable administrative charges in the first 6 months, then it's a negative. So that has been brought over to your administrative expense tab. We went through that a year ago. It's the same system. No problem. Okay. In case you guys haven't noticed, I'm sitting here with a little laryngitis. So if you excuse me a second, I'll be right back. I have to keep my throat with moist. Okay, there has been some problem with documentation that should be submitted for the reconciliation tab. For the most part, the documentation that is being sent in for the ending cash on hand has been good. You guys have been doing it. Just make sure you include all the cash, both your savings as well as your checking account money for the RLF. You've been doing that good, no problem. I'm proud of you. For the financial accounts reconciliation, there's been some misconception of what we're trying to go for here. When we say send in your general ledger, your balance sheet, what I'm trying to get from you is a listing of all your outstanding balances of RLF ED loans as of the end of the period. So sometimes your your general ledger will actually list each beginning balance for the period and ending balance for the period. Sometimes it won't. Sometimes it's your balance sheet that lists it. So whatever document you have that lists it, that is what is to be sent in. Okay. By the way, the amount of per financial books does not include the cash amount. It only includes the outstanding balance amount. Okay, the last one on here is the capitation rate. And one of the things that we will be doing this 6 months is if you are over the capitation rate, you must return the funds that are over. If the funds are not returned, you will receive a letter from the state requesting the funds. If you disagree with the capitation rate on this tab, I will not address this during the webinar. Please call or email me after the webinar. By the way, we are not trying to be punitive on this. We're trying to get the funds used. So if you're returning it to us, then we're giving it out in another manner to other localities. We're just trying to get the funds to be used. Now, that being said, you'll be able to talk to various people if you could, and they'll tell you, well, I just got my big loan paid off and I haven't had a chance to get it spent, or I have 3 loans in the process of being issued and I won't have the money if I have to turn back the money. Okay, that's an explanation for me, and if it's one's with significance and documentation, we give you a 6-month leeway on here for turning back the money. But if you don't have any plans to spend it, then it must be returned to the state. And any request for exemption of 6 months must be done in writing by email to the Decker, the DOH Community Development email website. And that would be about it. Any questions on here?
So Kim Manley has a question. She says, can Deb repeat the statement about the beginning balance? Is that the loan balances or the actual funds on hand?
Okay, the beginning balance for the RLF under financial account reconciliation, the RLF account balance per financial books, that is the outstanding loan balance as of the beginning of the period. So all your outstanding RLF ED loans, their balance would be what goes into line 47, and then line 58 would be the RLF account balance per the financial books, would be the outstanding loan balance at the end of the period.
Okay. So Jesse Bartman has a question. He says, so if we turn all the surplus back to the state and after a couple of months we have a request, I take it the state won't give us a grant back?
We will work with you to be able to get the money back out to the people, and it may just be done through an ED loan, and we would be giving you a grant back for the ED loan, which would be to give to the borrower and work it through that way. So yes, you would be able to get the money back in one manner or another. Okay. Okay, the biggest change you will find on this form is your RLF performance contracts. And the reason this occurred is because one of you asked for some of the changes, and it was a very good idea. And then I went, and as I was reviewing things, I also noticed that there's been some misconceptions in there, and the misconceptions was because of the way we wrote things. So we changed a few things. The first thing is line 15 through 17 on your performance contract. You will see 3 lines. One is total number of FTE employed at the start of the performance period. One's the total number of FTE full-time equivalent people employed at the end of the performance period and the difference. When you write out a contract or agreement to a business, they should be able to tell you the number of people they have employed, and they should be able to give you payroll sheets to document that. That's what goes into C15, cell C, line 15, column C, line 15. So this business, LMI, had 5 people at the start of their business that they were employed. Now, when the performance, when the performance period is done, they'll give you their payroll sheets again. And let's say for LMI, they had 10 people. So you put in 10, and that means that they hired 5 people that are still employed. And those 5 people that are still employed, you get you find their employee self-certification forms. And it's the last 5 people that were employed that are still working there. Now, technically, if everything was done right, this should agree to the amount in column T, may or may not, but you can change your final counts in column T here to what it's actually supposed to be at the end of the performance period. As you saw, we added sorry about that. We added those two. Now, the next thing we added because of the misconception, this is really because of the misconception of the way we wrote it. This information comes from your contract. So it's the total number of full-time equivalent positions to be created per the contract. And for LMI, it's 4. I just realized it's LMI business and LMI positions. Okay, the total of low to moderate income positions to be created per the contract has to be at least 51% of the 4. So that's a 3. Or if it's a retention, and remember, retention and maintenance are 2 different things. If it's a retention contract, you would be putting the information in line 23 and 24. So this all line 19 through 24 comes from your contract with the borrower. Okay. Now, line 26 to line 33 comes from the information from the employee self-certification forms. The information that's indicated for each period is the number of people that were hired or positions created during that period. It's not a cumulative figure. The cumulative figure is in column T. So in this case, from the employee self-certification form, for the first period, they hired 2 people, and both of them were low to moderate income. Then in the 331 period 3, they hired 1 person. However, it was above the low to moderate income. Next period, they didn't hire any. And this last period, they hired 1, and it was low to moderate income. They didn't, no employee left. So that means that they hired a total of 4 employees, and 3 of them are low to moderate income. Okay, that is if you're creating a period. If you're retaining a period, and remember I said retention is different than maintaining. Retention should only be used if a company or a major line of the company is going out of business. There should be otherwise no other retention. It's only if the company is going out of business, you're trying to save the company, that you would be putting in the number of persons retained, and that would indicate the same as the contract up on top. And you would just be indicating how many positions are retained all the way through. The information for race of jobs hasn't changed. You still need to put it in. Please indicate, notice in period 3 we only had 1 person created, but we had actually 2 Hispanics hired and 1 African American left. So it's a +2, a -1. And the same thing, they hired 2 laborers and they technician left to be a +1. There was a line in here, line 72, that was deleted and you don't have to fill in anymore.
Okay, we have 2 questions. One from Angie. She asks, what is the definition of FTE? Is it full-time equivalent or full-time employee?
FTE for RLF ED is full-time equivalent. That may be different from your ED loans that you receive from the state, but for the RLF ED, it's full-time equivalent. So that means you could have a 10-hour employee and a 30-hour employee to make 1 in FTE. So it's full-time equivalent.
And Jesse wants to know if the information is the same as the previous semi-monthly report, do we still need to resend a copy of the self-certifications and progress reports since it would be same as the last one?
Jesse, thanks. You went on to my next slide that you don't have necessarily the slide, but I do. Once the performance period ends, no additional performance information needs to be entered for the grant. And it's the UGLUG that is to ensure the employee self-certification forms are completed by the new hire. And if the performance requirements are not met, it is the UGLUG's responsibility to enforce the penalties indicated in the contract agreement promissory note. Okay, the forms can be found at, this is slide 24, the website is on there. Use the form corresponding to the year the person was hired. The form only has to be filled in once per person, not yearly, and therefore you only have to submit it once to me or to DOE. There is a few things on the new form, and before I get into it, the new form which I sent you, there's just one section and section 3, even though it says 1 on this sheet. And we got rid of some of the questions. One is are you disabled? So that doesn't have to be filled in anymore. We're just asking 3 questions for them to fill in. And we're also asking for the date hired. You will see that about 2/3 down on the form, the questions, and it's section 3. The 2016 numbers became available yesterday for MUD. The 2016 form should be posted by mid-April. Continue to use the 2015 numbers until the 2016 forms are available. You will be able to find those forms at that website that's indicated on slide 24. But we listened to you, we went through and we did research, and we decided that the disabilities wasn't necessarily needed for this. So this form now should help everybody in your hiring process. But please make sure the date hired is there because it will help you to monitor and it will help us to monitor.
So Ron has a question. Do we need to do self-certification surveys for the total number hired during the period or the number stated in the RLF contract? Example, RLF contract states 10 new hires, but company actually creates and hires 50.
you need to do for all positions that were hired during the performance period. So it doesn't matter what the contract says, but during the performance period, if they hired and the people were still working, 50 of them, then you need 50 self-certification forms. Any other questions?
So Dan asks, can you lend money to a business to prevent that business from leaving the community to another out-of-state business location? Asking about retention, I guess.
Then you get into, Dan, I think you and I need to talk about that because I don't have the answer. Honestly, I don't know because of pirating and the rules for that and everything else. So I'm going to have to research that. So please make sure you drop me an email and I will research that and get back to you. Anything else? We're going to be leaving the Excel form. If you have any more questions, now is the time.
So Deb asks, are self-cert forms still considered voluntary, or should we write into the contract that they're mandatory?
Can we wait a few minutes on that? And they are mandatory, and yes, it has to be in the contract. But I'll be actually giving you some ideas on how to write that into your contract.
So I'll just go back to one other question that Angie had at the beginning, asking, can you clarify if the actual employee self-certification form needs to be sent in as well as the ones they receive? Do they have to send them, I think, to the state? Is, I think, Angie's question.
Angie, you need to scan in the self-certification forms and send them in by email to DOH, to the Decker Community Development email website that you send everything else in. You maintain the actual ones at the UGLUG's office. And I think in the beginning there was a question on the DUNS number. Ben, do you remember that?
So Sherry asked, I've searched out the web and none of my loans have a DUNS number. What should she do?
Okay, if none of your loans have a DUNS number, that is fine. When I was saying about the DUNS number being put into the form, it's on the first page, and that's the UGLUG's DUNS number, and the UGLUG should have a DUNS number, and if it doesn't, it must go to the DUNS area and request it. And if you need help on that, give us a call and we'll try to help and tell you how to go about it doing it. Okay, I am leaving the Excel spreadsheet, and as you notice, there was less changes this time. I'm very happy to say. And we did some formatting changes where it came out dates, and it should now be text. So we've been cleaning up these reports. So if you're still having any problems with your report, please give me a call. Okay. Okay, from current slide. We are going into the RLF ED agreement and contracts. Okay, we've been asked in the past for examples and what needs to be in the contracts. The following pages that are coming up will list items that are necessary for your RLF ED loan agreement. This list is not all inclusive, and the examples are given only for demonstration purposes. The UGLUG, not DOA, is responsible for the content of the loan agreement. The UGLUG must have their attorney review the loan agreement prior to signing the agreement. And a promissory note without a loan agreement is not adequate. Okay. The first thing when you do your loan agreement, you need a scope of work. And that gives specific project details, a timetable, and job performance requirements. The project details is we're loaning you $300,000 to add equipment. The timetable will be that the equipment will be bought by a certain date, and the match, you also have matching funds in there, that the matching funds will be spent by a certain date. Your job performance requirements. Now these are examples. And it's 1, 2, 3, and it's not 3 examples, it's 1 example. So when you put in about job requirements into your contract, the borrower shall create and fill 10 new full-time equivalent positions in Reedsburg, Wisconsin by, and that's the ending job creation date. So that relates to your job creation, your performance date. Employee guarantees at least 51% of the new full-time equivalent positions created by the borrower in accordance with the paragraph above, which is number 1, shall be made available to low to moderate income persons. You may want to spell out LMI if you don't have it explained as a term in the beginning of your contract. And then number 3 is employee self-certification forms must be completed by each new hire and submitted to the name of the municipality, which I believe I said was Reedsburg. So that is an example of how you can ask for job performance requirements. And you're putting it right in there that they need to fill out an employee self-certification form.
So Dan has a question. Can the UGLUG extend the job creation date with the approval of the Business and Loan Committee?
The job creation date can be anywhere between, has to be a minimum of 1 year and a maximum of 5 years. We are recommending 2 years. Yes, you can extend the job creation date, but no more than 5 years. It has to be done within 5 years.
So Paula is asking, does the DOA provide a sample draft loan agreement?
No, as of this point, the DOA does not provide this. I am going to give you everything that is required by HUD in this webinar here. More specifics we can talk on the phone. I haven't gotten the DOA contract approved through the attorneys yet, and I don't know if I'm going to be able to. So, but this is approved through the attorneys, what I am giving you right now. The second thing you need is a budget, what the funds you will be used for, and matching fund requirement. The third thing you need is the source of funds. And this is the example, and basically you should be actually be writing this in the contract, that the United States government through HUD has allowed each state to elect to administer the CDBG funds subject to certain conditions. Of course, I'm skipping the words. You would be putting all the words in. The state has previously granted CDBG funds to Reedsburg for the purpose of granting economic development loans to various businesses subject to certain conditions. This is a reminder that the funds do not belong to the UGLUG or the state. What you have in your RLF ED funds is not owned by the UGLUG. It is not owned by the state. It is part of the federal CDBG funds and must be spent in accordance with CDBG rules. So that's just a little reminder, but this should be put into the contract per HUD. The next thing you need, excuse me, the next thing you need to attach, and this can be an attachment to your contract, is the promissory note. The promissory note would indicate the parties, who's giving the money, who's getting the money, the amount of the loan, the interest rate of the loan, the length of the loan, the repayment of the loan, the monthly, the lump sum, however, prepayment that they're allowed to prepay, what collateral and guarantees are there, consequences of default, and signatures of both party. Now that could be an attachment to your contract. It is your promissory note. The fifth item you want as an attachment to your contract is the amortization table of the loan. I'm looking at Ben just to see if he's gotten any questions.
So 2 questions. One from Jesse, just asking what specifications need to be put in the agreement specifically, and what will be sufficient just to be in the administrative manual to specify that these things are in the administrative manual. And then Dan just has a question about how do we defederalize these HUD funds?
As of right now, I'm going to answer Dan. As of right now, we are working with the 3105A15 entities to defederalize funds, and we are not looking to defederalize funds any further than that until the method that we're doing with the 3105A15s has been blessed by HUD and accepted before we look anywhere more to expand this program. Next question, Jesse, what I'm giving you here now should be in your contract, and anything else can be referenced to your RLF manual. And as I continue with the other slides, it will tell you what should be in your contract. Okay, in your contract, you should indicate that there are required reports and that the reports required by HUD, the state of Wisconsin, and or the UGLUG must be submitted when requested. These reports include, but is not limited to, the environmental review, the semi-annual job creation, the Section 3 report, the labor standards report, the MDWBE report, the disbursement journal, and the matching funds journal. Example for wording for the job creation, you can put in your contract for the period of April 1st through September 30th. The report and employee self-certification forms are due no later than October 7th. And if you do that in the contract and you get them in on the 7th of October, you're going to be able to make your November 15th deadline for your RLF report. And then for October 1st through March 31st, you put April 7th, you'll be able to make your May 15th deadline for submitting your report. So those are 2 examples you can put in your contract. Section 3 report, it's for the period of October 1st through September 30th. Please don't send any forms into us until we send you the forms. And I'm just trying to save you some time, because these forms seem to change every year. And usually in January, we will send out forms to all our UGLUGs saying this is the form you should be using and please return by whatever date, March 15th, March 1st. I don't remember what date it is. But please wait till you get the forms to fill this out. Don't go to our website and get the form, because I give you 90% chance that the form will change. And it changes because HUD always requires different information. So make it easy on yourself. Wait till you get the form to send it in.
So Dan has another question. At times, some businesses do not submit required information according to their ED RLF contract with that business. Is this a default? How does the UGLUG then complete its report to the DOA?
Okay, first of all, never hold up your RLF compliance report because somebody didn't submit employee self-certifications to you. So, your first question is really easy. What do you have in your contract that indicates that they would be in default or not? It's how your contract is written and what you can enforce to do your contract. If you have that they don't submit their forms in time and they have to pay a penalty fee, or they're considered in default and the loan can be called immediately, it's however you word it in your contract for it. And don't be afraid to enforce those clauses, because if you enforce them the first time, it won't happen the second time. Any more questions? By the way, I'm not trying to be a hard nose. I'm just trying to make your life a little bit easier. I may sound like I'm a hard nose right now by saying enforce it, enforce it. Of course, you have to consider the circumstances and go with the circumstances.
Yeah, so you haven't covered slide 30 yet?
No.
Okay. So I think you can keep there. We have questions about slide 30, but I think...
Well, I am on slide 30 right now.
Yeah. So people are asking if you can explain the environmental review report requirement and the section 3 requirement that everyone needs to complete.
Okay, the environmental review requirement, we've talked about the last couple webinars. Every loan needs to have an environmental review done. Now, when I say that, I don't necessarily mean going out and doing an environmental review, but doing the documentation that would indicate that an environmental review is not necessary. And if you go on our, first of all, at the end of this, I'm going to show you where our old webinars are. And I'll show you, if I can bring up our website, I will show you where to find the information on environmental reviews. And for Section 3 reports, we got a little bit more coming up later in this presentation with that. And I'm going to put that off until that point of time.
What's Section 3? Does everyone need to complete it?
I'm putting Section 3 off.
Okay.
Anything else? Okay. On here, also put a clause in your contract that, whatever your name is, reserves the right to amend and require additional information or reports as needed. This is basically to cover ourselves in case HUD changes their reports. This may be something that may be a little difficult to do in your contracts. You may have to amend this wording a little bit as required by HUD instead of as needed or as required by HUD. But just cover yourself if you can in your contracts with that clause.
And should they amend existing contracts or use this language in new contracts moving forward?
We just went through a whole portion of amending old contracts. It is so much easier if you use this going forward and not amend. But if it's necessary to go back and amend, like your contract's only 3 months old, and you can do it, then go ahead and do it. But it's from this time forward. Okay. This page has a whole bunch of program rules and regulations. This should be put in the contract that this program goes under these rules and regulations, and you just copy the wording and everything else for that. This also could be the section where you put in your RLF manual, that you also follow the UGLUG's RLF manual. I'm not going to go through every rule and go through it, but it should be in the contract that the borrower needs to follow these rules. Now, Davis-Bacon, if you know anything, is a construction one. You may not necessarily have it. Acquisition and relocation, you may not necessarily have it for this loan, but put it in, make it a standardized clause of your contract, and you're fine. It doesn't mean that it has to be followed, and being followed may just mean it doesn't apply to us. Okay. Other contract clauses that you need are monitoring by the UGLUG state or hub, that we have the right to monitor, that they must maintain their records or send the records into the UGLUG. Indemnification, conflict of interest, that the conflict of interest would be between the borrower and the approval of the loan, the board, that none of that is in there, that there's no conflict, that they won't discriminate, that they will follow small business, women-owned and minority-owned businesses if they can. Now, some of this is if you can. You need to put in termination of the contract. When can a contract be terminated? Consequences of failure to perform. You need bonding and insurance in here because they're borrowing money from you. So if the business burns down, you will never be able to collect your money. You need information about debarment, suspension in the indication, and you need guarantees and collateral. That's very important because if they're not going to pay the loan, you need to go after their guarantee and collateral and try to collect our money that way, not our money, HUD's money. So those are the other contract clauses that should be in your contract. And if you're going to ask me for wording of how all of this works, just send in the notice and we will get the wording out to you.
So Angie has a question about Davis-Bacon. She says, if a business is granted an equipment loan, does the install of the equipment fall under Davis-Bacon?
I'm going to say 20%, Ben. I will show you where the rules are, and I believe it's 20%. If it's less than 20% of the invoice, then it does not fall under Davis-Bacon. I think it's 20%, but we can always double check if you do have equipment and you have installation. It's always good to double check that percentage. And I'll show you where it can be done and checked.
And then Paula just has a question about whether you can share the exact contract clause wording for these things, or just the categories.
I will be working on the contract clause wording. Let's put it that way. Right now, and it would only be examples. But right now, this would be it. We have a standardized contract clause, boilerplate we call it for our contracts. So if you have a PF loan, a public facilities loan, planning loan from us, economic development loan, if you sign one of them with us, the ones that are coming out for 2015 and 2016 has a new boilerplate, and that would be a very good place to look for wording. But this is my third thing of working on, is the wording for the loan agreements and trying to get that approved. Okay. Section 3 reports. All borrowers must complete a Section 3 report every year during the job creation and retention period. Once the job creation and retention period is done, the borrower has fulfilled his obligations. The UGLUG will be responsible to distribute the report to the borrower, receive the report back, and submit them to Decker every year. And before you can give them to the borrower, Decker will turn around, or DOA will turn around and submit it to the UGLUG and tell them to get that information. And it's once a year, and it's usually in the January, February time period. This is a copy of the report done in sections. The DOA agreement number, this report is used for all of CDBG and a whole bunch of other programs. So your DOA agreement number is RLF ED and your UGLUG name. And your program is CDBG. Down here, CDBG. So here is when you would put RLF ED Reedsburg, and here is where you would be checking CDBG. This is a little bit more expanded, and it's the new hires. And it's not only the new hires that contractors would be hiring to perform this job, and this is different than what you've been told in the past. We got some clarification on it. It also would be the new hires that the business hired. So not only would you be reporting in on the employee self-certification form, but you also would be reporting on the Section 3 form. The difference is number of new hires and number of new hires that are Section 3 residents. I'll tell you something, Section 3 is low to moderate income. I don't know why we can't always talk the same language, but Section 3 is low to moderate income. Remember, if you don't have anything to fill a cell, you put a 0 in there. This is one form that you can't leave anything blank. When you receive this form, full instructions comes with this form on how to fill it out. I included this time to tell you that the difference here that's being changed is the borrower also fills out this form, as well as any contractors they have that they use the money for.
So a couple questions. Nancy asks, so do Section 3 reports need to be completed for loans that do not involve construction?
Yes. Section 3 reports need to be completed for all loans through the job creation and retention period every year. And the construction number would be $0 amount.
Then Jesse has a question. So the Section 3 reports for the period of October 2014 to September 2015, when will that report form be sent out?
You're getting blessed this year and the report's not coming out. You will not have to fill it out for the September 30th of 2015. You already have sent me in some of those reports already, and we're going to be starting with next year with the new report. That's it.
Well, we just got a couple more.
Of course we did, and that's fine because this is a report that everybody just absolutely loves.
Okay, so Dan asks, if M&E installation is less than 20%, does the borrower and contractor still need to fill out the Section 3 report?
A Section 3 report has nothing to do with Bacon Davis. The borrower will still have to fill out this report. The installer will still have to fill out this report. It has nothing to do with the 20% for Bacon Davis. Anytime a contract is, the borrower has to fill it out, and anybody that has done any contracts with the money that they have received from through the borrowing, if they borrow $500,000 and they use that on a contract, then it has to be filled out, whether it's construction or non-construction.
And then finally, Roxanne has just a general question about about the Section 3 reports and having contractors complete it. Wouldn't it be easier to have the contractors complete it during construction? And she's saying it would be more difficult to do it, you know, after the fact, go back to the contractors to get them to complete it. So do you have any suggestions for that?
Roxanne, you have a very good point. We've been fighting, not fighting, this has been a constant problem we have with our facilities projects, that the contractor's gone. All I can tell you is we do have the most recent Section 3 out on our website. And if you decide to do it that way, you may have to transfer the information to the new form. If you use the old form and it's just a different format, you may have to transfer it to the new form to have it done. If something, you can tell the contractor, here, do it. We may have to come back and get a little bit more information later on. But for the most part, if it's a contract, you can do it at that point in time, and then may or may not, the UGLUB may just be able to transfer to the new form. So you do what you can to get it done. And I'm sorry that this is a difficult process. It's a difficult process for all of us.
And then Deb just wants to clarify, so are Section 3 reports still only for ED loans, not RLFs? Which years do they apply to?
Section 3 reports are for ED loans, for RLF ED loans, and it's through the job performance period. So if you have 2 years that they have to create the jobs, those are the 2 years. Each of those 2 years you have to do a Section 3 report. If you have a 1-year job creation period, you only have to do it 1 year. And then if you decide to go 5 years with a job creation, you have to do this report for all 5 years. And the information is filled out only for that period of time, that 1-year period. It's not a cumulative report. It's a period report. So if your contractor works only the first year on the project and doesn't work the second year on the project, the first year he fills out the report. Second year you fill out the report with all zeros.
And then Angie just has a question about if this is a if the report is not only on construction, can you explain how a building loan of $125,000 would fill out Section 3 report, just for example? So I'm going to go ahead and try to answer this and see if you agree. So Angie, if you had a economic development type loan and none of that award was for construction or construction related contracts, then it would be, you would put $0 under construction contracted total dollar amounts and $0 under non-construction contracts, which if you follow the instructions for the Section 3 form that are on their website, it says non-construction dollar amounts relate to construction, so things like engineering. So if it's just economic development, you do need to complete the Section 3 report. You do need to fill out the Part 1 about the job information, but you would put $0 for construction contracts and for non-construction contracts. I believe that's correct. Deb will correct me if it's wrong.
I'm shaking my head yes. Ben is right. Okay.
Okay, and then Todd just has one question. When you say a period report, it's like a balance sheet. What's taken place as of that date? So
I flip back to slide 36. The HUD reporting period for this report would be October 1st of 2014 through September 30th of 2015. That's your period report. Next year it will say October 1st of 2015 through September 30th of 2016. That's the period report. So you would only be reporting for that period of time that's on this, the highlighted row. Okay? Good. Any more, Ben? Okay. This is the part 3 and part 4. I just continued with it, so because it's the rest of the form. Okay. I believe this is the last area we're going to be touching. We as in me, have been monitoring at least 2 RLF EDs every month. There's 2 different kinds of monitoring, on-site and desk monitoring. You as the log will receive a letter indicating the results of the monitoring. If any findings are noted, the CEO, the Chief Executive Officer, which is either your county exec, mayor, village president, will need to provide a written response within 30 days of what will be done to resolve the finding. And for any of you that have gone through a single audit or a audited financial statement and you get a finding from your auditors, you would respond in the same manner. So it would be in that format that you would write the letter, Dear DOA, we received your report. We have noticed that there has been one finding. The finding is on this. We have done this to resolve the issue, and we will do this to ensure that it never happens again, is basically how you will resolve the finding. And for those of you that have been monitored in the past year and has not sent back the results of the monitoring, you will be contacted very shortly for the letter to please send it back. When I do a monitoring, depending if it's a desk monitoring, that basically is your compliance report. So I'm monitoring that all the way through, and I usually contact you to indicate as such. The one thing that I don't usually contact on is if you haven't submitted the report and I have followed up with you, the UGLUG, and then the second email goes to the county exec or mayor, and then the third becomes a monitoring report saying you haven't responded. You need to respond or you need to return the money to the state to be allocated out. So now, common errors that we've been noting is contracts not completed, only promissory notes are completed. So therefore, with a promissory note being completed, there's no job requirements. And that's a problem. You must be using, you must have job requirements in your contract. You're also not indicating that they must follow any of the HUD rules. The next problem is funds are not being used. And we're asking UGLUGs to return the funds to the state so they can be used by others. And before you take a deep breath and say, I just didn't use it the past month. No, I went back through, I think it's 2013, if it hasn't been used since July 1st or 2013. If you haven't loaned out any money or received any money back in, letters have been written asking for the funds to be used or to be returned. And again, it's not punitive, it's the fact that we want the funds returned. Available funds more than the capitation rate, and they're not being returned to DOA. Again, we've already talked about that. Inactive loans not being followed up. And that's why we're doing the bankruptcy, the inactive loan summary. Environmental reviews not completed. Some of that is because you guys, the UGLUGs were just informed about that about 3 webinars ago. But we got to make sure that those are being completed. Those are basically the common errors that we have been finding. Administrative expenses not documented, but for the most part, you're doing very good on that. If I'm missing something that, like, let's say you forgot to send in a bank statement and I'm doing a monitoring, I will contact you for that bank statement. I just won't write you up that you didn't send it in, or write you up. I won't have a finding that you did not send it in. We try to resolve all the findings that we can ahead of time. One of the things is this will take you to our old archive file for the old training. And the 331 training webinar includes information on where to get all the training documents and all the other information. And you can write in any questions now. I am going to our website to show you where you can find different things. But for the most part, the webinar is done. I thank you for participating. Send in any questions. We'll be here for a while answering. I will keep the mic open to talk about where to find all the documents.
All right, so Angie has a question just about monitoring. She asks, on RLF loans given prior to DOA inheriting the loans, how far back are you monitoring?
I'm monitoring for the most part the new loans. I am not monitoring the old loans. What I am monitoring the old loans for is follow-up and repayment of them. But I am not going back to a lot of the old loans to make sure this, and this is being done, unless you don't have any recent loans. Right now I have our website up, and it's DOA, State Wisconsin Divisions Housing. And I go into the community development one. And the training one that's on the last slide will take you into this archive. And towards the bottom is the training webinars that have been done. Training slides are the PowerPoints. So if you go into the 331 PowerPoint and you bring it up, and let's go to about 22. That talks about job creation. Number 17 starts the HUD regulations, and it goes through here. And it will show you where you can get information, self-certification forms, environmental review, where you can go and get the environmental review information. And it goes through there. So if you still have questions on that, you can go back to that to get that information. And training archive, TOA. The other thing is under public facilities is the implementation handbook. And it's CDBG, and the rules for CDBG follows all the way through. So whether it's public facilities or revolving loan, the implementation handbook applies to all. So if you want to go in any more for environmental review and find it, it's there. Financial management's there. Labor standards for Bacon Davis is there. Section 3 is here. So if you need to know anything more about that, you can go to our main website and go under Public Facilities Program for Training.
Okay, so we have a few questions. I'll try to hit them and then pass the microphone over to Deb on these. So the first one is, who does the environmental reviews and who pays for it? If the UGLUG pays, does it get reported under the administration charges?
Okay, for 95% of the environmental reviews, you will be filling out 2 pages saying that you're exempt from doing a full environmental review. Normally in the PF program, our environmental reviews are done by the person receiving the money. In your case, it's up to you if you're going to require the borrower to do it or the UGLUG to do it. If the UGLUG's doing it and you can charge it off against administration, I would actually have the borrower do it. That would be my preference. But for the most part, if you're only doing a 2-page environmental review, that takes maybe 15 minutes to do and send in.
Okay, so we have a couple other questions. I'm going to put the job creation questions at the end together. The other ones are, so Section 3, Victoria has a question about Section 3 reports. Do they only need to be sent in if you send them to the UGLUG per the bottom of page 35? So yes, Victoria, we will send you the Section 3 reports that you need to complete because sometimes they change slightly from year to year. Then the next question, there's another question from Susan. Are you able to give us an update on the status of finalizing the revised loan manual?
No, I can't give you a status on that. I know we've been working on it, but I can't give you a status, and I'm not going to promise something that I can't deliver by the due date.
Okay, so then we have some questions about job retention requirements and what is job maintenance. Could you cover a little bit of job maintenance and retention for RLF purposes?
Okay. This goes back to our history here at the state of Wisconsin. The contracts used to be written out that you had to create a job within 2 years and then maintain them for another 2 years. and they actually used the word retain, not maintain. And the reason for that is they wanted to make sure that everybody didn't hire 5 people the last day of the job creation period and then get rid of them the next day. So they made their goals. So the job creation period is the time you give them to create the job. The maintenance time is the time that if the UGLA wants to do it, and it has nothing to do with the state, is you request them to maintain these jobs for an additional 2-3 years. Just remember, if you do that, you're going to be obligated to monitor the job maintaining period, and we will be coming in to make sure you are monitoring that period. So some of the old contracts go 20 years, and you got to monitor it for every single one of those years. So be realistic on how you set that up. HUD requires job creation. HUD's definition for job retention is only if a business is going out of business or a line of a business is going out of business, and you want to give them money to stay in business. And that's retaining jobs that when you give them the money, the jobs are already there. So the company has 50 people already hired. They're going out of business. You're going to give them $100,000 to stay in business. And you give them that they have to stay in business for 2 years. And they have to maintain those 50 jobs for those 2 years. They have to retain those 50 jobs. So that is, people are already hired and they're being retained.
So then another question from Jean about slide 27. So it refers to 51% of jobs are to be made available to LMI, whereas on the performance reports, it's jobs created, or 51%. And so Jean asks, how is it handled if the jobs are made available to LMI, but others were actually hired?
Jean, we are trying to resolve that issue because HUD will not, even though it's regulations, HUD does not allow us to report jobs that are available to LMI. And by the way they report, it makes it seem like we are not meeting our target, and we are in contact with HUD right now to try to resolve that. And as soon as that is resolved, I will get BGAIN back to you. And just so you know, when I say resolved, that doesn't mean it's going to be resolved in the next week or two. This may take months.
Can I have one? Sure. And I would just add to that, Jean, that so there are the issues of, you know, in the regulations, what it says about the definitions for made available to or held by. But the 51% is about having a majority benefit to low to moderate income persons. And the reason some of the forms you'll see gravitate towards the held by and looking at the self-certification forms is because that's actually going to be one of the simplest ways to document, straightforward ways to document the low to moderate income. There are, as we are in conversations with HUD, there are ways to document that they have been made available to, but not held by. But as Deb's kind of saying, this is more complicated. In general, it's going to be more documentation. And so just in terms of your thinking, like the held by, definitely, if you demonstrate that 51% of the jobs are held by low to moderate income persons, you've definitely met a national objective. If you can't demonstrate that, you have to demonstrate the made available to, and that's some more extensive documentation required to demonstrate that. At least that's from the non-RLF ED side that I'm on, to to provide that clarification.
Any other questions? Okay, I thank you guys for putting up with my voice today. I know it's been very gravelly for you. And like I said, thank you for that. We'll stay on the line for a few more minutes, but right now we have no more questions. You can sign off and have a good day. Call with any questions or email me. I'm available. And like I said, have a good day.